monetary policy and the macroprudential policy for the 2025. We will try to understand what's happening, especially in Europe. And as you know, the financial market is linked to each other. And yesterday, the Fed decision rate comes to an end for the rate cut process, and they gave some signals for the monetary policy standing for the next year. For that reason, today I will try to understand and help you understand what's happening, especially in European Central Bank side and European financial indicators like the industrial production, current account deficit, or any type of macroprudential policy side. One of the most important topic, what is bringing the monetary policy in the case side, is today the inflation pressure all around the world, and what can adjust the central bank decision-making process and how they adjust their monetary policy stance according to inflation indicators. On the left-hand side here, in this graph, you will see three region and countries core inflation. The y-axis showing the year-over-year percentage change, and the x-axis showing the time, the date, approximately 20 years from 2003 until today. And here you will see the change in inflation rate. And the black is United States, purple is the Eurozone, and the light blue is United Kingdom. There are three important dates here. One is exactly here, before the global financial crisis in 2008. Then, after the global financial crisis in 2008. And another really important point for the world here, the peak up of the inflation after 40 years, around 7%. This is an unprecedented issue for the United States, United Kingdom, or the Eurozone, because no country in this region experienced such a high inflation during 40 years after the oil shock in 1970s. Here, there's a sudden contraction in the core inflation rate, and this date is exactly the COVID-19 crisis. When the COVID-19 started, all the economies started to take some measures, especially to close all the economic activities on the street. Restaurant closed, lots of shutdown in all economies and curtains. Then the central bank, because the economies are contracting and GDP, gross domestic product, are contracted, the economies take some measures. The first of all is the rate cut for the zero lower bound. It is the quantitative easing, meaning asset-backed securities and mortgage-backed securities buying from the market and excessive liquidity in return, meaning cheaper money. Because if people don't buy something, there will be no demand, there will be no inflation, and there will be no growth. Yes, the inflation is a bad phenomenon, but deflation is also bad, meaning that nobody in the world wants an excessive price increase or high inflation, but nobody also don't want any sharp down and decrease in the inflation too much. Because if the inflation is really decreasing, meaning that economy is not growing. Inflation and the GDP growth is a cyclical indicators, meaning that if there is inflation in the economy is growing. If there is deflation, meaning that prices is decreasing, like the China during the last 20 years, or sorry, not the Japan, last 20 years, the deflation process in Japan, decreasing the prices and growth is really steady, like the recession in the economy. So here, as you see, after the quantitative easing, asset-backed securities and mortgage-backed securities buying from the market prices, there's a huge inflation here. Then, when the economies understand this inflation process will be a structural breakdown in the price dynamics of the household, consumer, and investor, then they, because all countries here around the central bank of the countries, like the United States Central Bank, Federal Reserve, or the Eurozone Central Bank, European Central Bank, ECB, or the Bank of England, United Kingdom Central Bank, have the inflation target approximately around 2%. So if this inflation, the current inflation here, goes above the inflation target here, you need to adjust your monetary policy to decrease the inflation again. Then, until here, the economy is funding the market with the zero lower cost, just around 0% interest rate. When the inflation reached these peaks, then they started to increase the interest rate to bring down the inflation accordingly. And today, yesterday in monetary policy meeting of the Federal Reserve, or the 2 weeks ago European Central Bank interest rate decision, both decreased the interest rate 25 basis points accordingly. And they are funding the market around here. The current interest rate is around here. But what is the problem? The problem is this. When the inflation goes here, normally the inflation rate, as you see here, around 2% in those three economies. But when the inflation rises above the 5, 6, or 7%, then the consumer expectation for the next couple of years, the inflation inertia becomes a problem in their mind. And they are supposing that inflation will be such a big phenomenon in their price or decision-making process. And in the right-hand side, in the slide, as you see here, market-based inflation expectation. These are, again, the three economies, and the graphs is here. Inflation expectation for the years, as you see, around 3.5%. But we know that they have the inflation target around 2%, right? Again, still above their inflation target, as you see here. So if the inflation is a big phenomenon for their mind, they will be a little bit prudential to decrease the interest rate too much and in every meeting of the monetary policy. Because in the June meeting, when the European Central Bank started to decrease the interest rate in 2 consecutive months, they see that still the inflation pressure coming into mind, that there will be high inflation than expected. So the inflation expectation for the next 12 months, meaning next year, the inflation expectation in their mind will determine their monetary policy stance. And today, in the current position, the Fed or the European Central Bank sees some risk in upside in the inflation. So they are a little bit prudential while cutting the interest rate. Now, the global monetary policy. As you see here, let's say we are here in 2024, and these are the years: 1 year ahead, 2 year ahead, and 3 year ahead. As you see here in this graph, we will add just one country. Normally here we have United States, Eurozone, and United Kingdom. But now with the green, the Japan is coming into mind. But what is the problem for the Japan case? Look at these three regions: Eurozone, United States, and the Bank of England. They are cutting the interest rate for the next couple of years. But what is dramatic for the Japan? They are increasing the interest rate. They have counter-cyclical policy against the rest of the world. They are increasing the interest rate because what can be the problem? Inflation. Japan, a few minutes ago, I said to you, if the prices in a deflationary process, there will be no inflation in the market and there will be no growth. Japan, during 20 years, around just 0% inflation, and their economy is not growing. But after 20 years, Japan, for the first time after 20 years, see an inflation upside risk in the market. because their economy, after lots of expansionary process in monetary and fiscal policy, they see some growth in the GDP and they see some upside risk in the inflation. To deal with this high inflation process for the next couple of years, they increase their interest rate around 1%. Approximately in 2 consecutive monetary policy meetings, 40 basis points, 25 basis points, and 15 basis points, 40 basis points totally in interest rate hike process. And here, the most dramatic case is this. Those 3 biggest economies or biggest region in the world decreasing the interest rate because they have huge inflation, and to decrease those inflation, because after the monetary policy contraction and the hike in the interest rate, they bring down the inflation consecutively. Please look at this picture. Here, the inflation is going down in those 3 regions, and then they started to decrease their interest rate accordingly, because there is no need high interest rate in the market, because economy is contracting, employment market is cooling, so we can fund the market with lower interest rate. Otherwise, if we fund the market from here, when the inflation here, the real interest rate will be really positive and economy will be contracted. There will be no consumption, there will be no investment. The people will just save the money with this environment. And here, on the right-hand side, we have the global central bank balance sheet. These are the asset purchase programs coming from the asset-backed securities and mortgage-backed securities from the market. This is the total money. And please look at this picture. Normally here, in 2008 global financial crisis, totally central banks approximately $3 or $4 trillion total asset-backed securities and mortgage-backed securities buying from the market. But here, from 15 trillion, we reached approximately 27, meaning $12 trillion asset purchases from the market. This is a huge money. $12 trillion meaning that greater than Italy, France, and Germany gross domestic product. This is a huge money. $12 trillion totally. So this asset in the central bank balance sheet brings some contraction in the economy. So they are selling those assets like the treasury bills or government bonds, like the asset-backed securities or mortgage-backed securities coming from the market. And then they decrease all the assets from $27 trillion to 20. But they are still contracting their balance sheet as the inflation goes down. We covered the monetary policy with some brief slides, but another branch of the inflation to deal with the inflation is fiscal policy side. And here, as you see on the left-hand side, again, 3 zones, United States, Eurozone, and United Kingdom. And this is public sector investment, meaning government expenditure or government finance. And this is percentage year-over-year change and moving average. Here, as you see, in the global financial crisis of 2008, there's a huge contraction in fiscal policy. Then, when the economies recover the disadvantage of the global financial crisis, the average for the fiscal policy year-over-year change is around 5%. So, the fiscal policy turned to time path, the long-run time path again. But now, with the COVID-19 crisis, it has a huge rise from approximately 5% to 8, or for instance, for the United Kingdom, it is around 10% for the government fiscal policy. But now they also adjust accordingly their contraction in fiscal policy. Why? Because prices can increase any expansionary policy. If it is coming from the monetary policy side, yes, it put a pressure on the inflation to go upside. But let's say the monetary policy is neutral. There will be no buying from the market. There is no expansion in monetary policy. Does this mean that there will be no inflation in the market? No. Because if the fiscal policy is also expansionary, this can also create aggregate demand, and this can also create an inflation pressure in the market. So we should keep in mind that inflation does not come only from the monetary policy side. Inflation can create even from the government. If the government expenditure, if the expansion in fiscal policy is coming from the government side, then this will be put some pressure on the prices and upside risk in the inflation. And here we have budget balance as percentage of the nominal GDP for those three biggest economies. And normally, as you see, the budget deficit around 3% for those economies. But in the global financial crisis, budget deficit reached to 10%. And in the COVID-19 crisis, budget deficit reached around 15 or 20%. This is a huge budget deficit. Why? Because governments sent the check and banknote to the household to pay more, to consume more. For instance, approximately 30 million United States citizens take 1,000 check from the government because they don't have the purchasing power. They don't have enough money to buy something from the market because they don't have any salary. They close their restaurant, they close their services sector, and they don't have money. And government send the money, check and banknote to those households to buy more something. And these banknotes and checks from the government budget create a huge deficit, especially in the United States, approximately, as you see, 18% budget deficit. But currently, after the crisis effect passed through from the market, then we will turn back again the 3% budget deficit target for those three economies as well. Today, I think the biggest problem is not inflation. The biggest problem is the total government debt in the economies. We know from 2010 to 2020, during 10 years, the biggest government debt coming from the Japan side, because their government debt totally 200% of their total GDP. Yes, it is a huge debt for the Japanese economy, but they are in the deflation and they are in the recessionary process and they are giving budget deficit. They are putting expansionary fiscal policy to increase the demand in the market. But now today, not just the Japan, but also United Kingdom, Eurozone, and the United States giving huge total government debt compared to their nominal GDP. Why? Please look at the picture here. There's a huge shift. Normally, during 10 years, as you see here, the total government debt is less than the nominal GDP. If the nominal GDP is 100, the total government debt around 90 or 80% of the total nominal GDP. But today, in United States, the nominal GDP is less than the total government. Today, we know that the total government debt around $40 trillion in the United States. $40 trillion total debt, meaning that every citizen has a huge debt in their pocket, but they don't know. They have some money, but it is just a nominal money. You don't know how much net income you have. Yes, you have some asset, but you have lots of liabilities coming from the government debt in your mind. And it is total debt. Every citizen of the United States should pay it in the long run. And it is 40 trillion today, and higher than the nominal GDP of the United States. This is not normal for the United States case because in 2000, for instance, just 60% of the GDP is total debt. But today, it is double. There is a huge public debt total public debt in these three economies, and this is putting a high pressure on the purchasing power and price dynamics of the economies as well. For that reason, please look at here again. This is the government interest payment, again, percentage of the nominal GDP. How? Because you have a total debt, you have every month or every quarter, you are paying some interest on their total debt, right? Because you are borrowing some loan from the market, and you are paying interest in return. And what is the share of this interest payment compared to nominal GDP? Normally, it is around 3 or 2.5% for these three economies. But as the total debt of the government rising, here as you see, the United States in the 2025, next year, will pay approximately 4.5% interest payment for their total debt. Just think this. You have around $40 trillion total debt, and each year you will pay 4.5% interest, meaning that around $2 trillion interest you are paying every year. This is just interest payment, $2 trillion. Just think the GDP of the countries. Today, $2 trillion, meaning that higher than Brazilian, Turkey, South Africa, Indonesia, or these economies' GDP, meaning United States interest payment higher than the GDP of these economies. This is a huge money, and this is a huge debt. And now we are focusing on the global consumer balance sheet. These are the consumer side. Please look at this. Nominal house prices in this economy. Please look at the color here. The black United States, purple Germany, light blue is the United Kingdom, dark blue is the Sweden, light green is the Spain, orange is the France, and the Italy is the dark green. And as you see here, the house prices contracting during the global financial crisis. Then, if please look at this, 2015, 1 second, please. Sorry for the interruption. It's an unexpected condition from my side. As you see here,
No matter.
If we take 100 in 2015 as the index, normally before the global financial crisis, house prices was peaked, but then it suddenly decreased to the 100. But what is the problem? As you see here, the house prices, for instance, in the United States, if 2015 is 100, it is converging to 200, meaning that if I have a house in the United States that has cost me $1 million in 2015, without any investment on that home, now if somebody else wants to buy my home, it will be cost $2 million. House price in the United States doubled, but where the house price is a little bit steepy, it is in Italy, for instance. If it is 1 million in the 2015, it is around still 1.2 million. But in the United States, housing market is really, really expensive. But in 10 years, even other than the Italy, all countries experiencing huge increase in the house prices. This is the result of the huge inflation in the economies. Inflation brings everything expensive, including the house prices. And this is really, really dramatic in Germany and the United States case, as you see here. The house prices is really, really high. And if I take a look at the household debt, yes, household income and household investment like house price is increasing. But how about the household debt? Please look at these shading gray line are the recession in the economies. Okay, this is the dot-com crisis in the United States, 2001. This is the global financial crisis, and this is the COVID-19 crisis. As you see here, in the global financial crisis 2008, the household debt was peaked out. Then households decreased their total debt until the COVID-19 crisis. But then suddenly another shift in the household debt. Why? Because especially in the 2019 COVID crisis, people in the household sector lack of from the money. They can't go to the work. They can't open their restaurant. They can't give any other services in their shopping. And they need money to survive. For that reason, they borrow from the central banks and the banks with cheaper cost, like zero lower cost interest rate. Then they increase their total debt. And today, as you see, the highest total debt for the household perspective is in the United Kingdom, approximately 95% of the nominal GDP, and the lowest in the Spain, as you see, and the United States around 80%, 75, 80%, meaning that households still high debt in their pockets, but lower than the global financial crisis side. And please look at this. We will pass the European Central Bank side after this slide. This is US economic monitor. This is US economic indicators. These are the historical data since 1990s. And here, please look at these bars. Conference Board Lending Economic Index and Conference Board Lending Credit Index. This is broad indicators for the lending side of the economy. And here, consumer and services side, consumer confidence and ISM non-manufacturing, PMI index, okay, purchasing manager index. Here, as you see, the manufacturing side. This is non-manufacturing and this is manufacturing. We have purchasing manager index, meaning that kitchen in the market. In the financial market, you can see lots of numbers, but those are just numbers in the banks. That is not production is there. But in manufacturing side, purchasing manager index, this is showing exactly the real production, like the production coming from the factories, orders coming for the durable goods from the rest of the world. This is the purchasing manager index. Manufacturing new orders, ISM manufacturing. And this is the labor market, non-farm payroll, meaning how the labor market is cooling or heating. If non-farm payroll is increasing, meaning that economy is fully employed and there is no problem in the non-farm payroll side. But if the non-farm payroll application is decreasing, meaning that economy giving a huge unemployment rate. And here, these color showing the lower, this green one is lower recession risk, and if it is the red one, this is higher recession risk. And please take a look at here. Normally, ISM manufacturing giving huge higher recession risk. Why? Because production is dying in the United States as well. But for the employment side, economy is really a satisfactory result. Yesterday, while the Powell making the monetary policy speech in the United States Federal Reserve, he mentioned that we will be prudential while cutting interest rate as the GDP and employment market give such opportunity, meaning that our employment market is too strong. For that reason, we can still wait to cut the interest rate. If employment market have in problem, or if the unemployment rate is higher than the Fed expectation in the market, they will be really hurry in to cut the interest rate, because you should trigger the inflation and demand in the market to decrease the unemployment rate. But today, the United States have a really strong employment market. For that reason, they can wait until the employment market fully cooling and inflation go down to the central bank target. This is the United States Federal Reserve policy, approximately 50 years. As you see, this is the time horizon. Oil crisis, the Afghanistan and Iranian shocks in the oil market, gold crisis, dot-com crisis, global financial crisis, and the COVID crisis. In each crisis, in each recessionary period, as you see, the interest rate is decreasing, 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 again decreasing, decreasing, and decreasing. But now, as you see, long-run projection, because the target for the interest rate will be around 2 or 3%, and long-run projection for the United States around 2.3% for today. But we are far away in the current situation because Federal Reserve funding the market is 4.5, and a few minutes ago I say they are prudential while cutting the interest rate. They don't cut the interest rate in every quarter or in every monetary policy meeting, and they are saying that we will follow the market data and indicators while cutting the interest rate. Now we are on the US inflation side. This picture is important because I will give Eurozone economic monitor and Eurozone inflation as well. Let's try to understand what is this slide meaning about the inflation expectation and what this slide we need to find that inflation composition adjusting during approximately 2 or 3 years. Now, as you see here, this is from May 22 until November 23. Let's say we have can everybody hear me because sometimes the screen is missing. Hi there.
Hello.
Can you hear me?
Yeah, just cutting a little bit cutting. Line is breaking. Check the. I don't know what's happening. Connection issues.
Okay. I'm
Now
closing
I
my
can hear you
camera
clearly.
first of all. Okay. Because
I can hear you now. We can hear you.
Okay. The camera sometimes decreasing the internet quality. For that reason, I close my camera. As you see here, from May 22 till now, we have the inflation composition, and normally how the inflation is coming for the market structure, when we take a look at those indicators: private sheltering, restaurant, hotels and transport, food at home, autos, energy, other, and total is this line. Please look at after the COVID-19 crisis. For instance, the biggest contribution, especially after the Russia invaded the Ukraine, the biggest contribution for the inflation coming from the energy side. Approximately, as you see, 2 points from the energy side. But today, energy is minus. There is no contribution from the energy to the inflation. Okay, and another biggest side, as you see here, autos. Please look at this one, this purple one. Autos putting 1 point for the inflation, but now there's no autos. What is the biggest problem today? Please look at this one, dark blue, private shelter. This is an inflation inertia, still approximately 2.5% for the inflation contribution. And another biggest one, services sector, restaurant, hotels, and transport, the light blue. And the last one is coming from the food and the other, small one. So there is no auto, energy, or those type of inflation contribution that is coming from after the Russian-Ukraine conflict and the COVID-19 crisis. Today, the biggest problem coming from the private sheltering, and it is coming from the services sector, like the restaurant, hotel, those type of the enjoyments. And here we have United States goods and services inflation. Please look at the divergence when we look at the services and the non-food, non-energy. Normally it is around 3%, but after the COVID-19 crisis, non-food, non-energy inflation is peaked up above the 12% and decreased suddenly, as you see. Please look at the purple line. It is shifting to 12%, and now it is just zero. But the services inflation is not. It is stubborn. As you see here, this light blue still contributing to inflation 1.5%, meaning that there is higher inflation pressure from the services sector, and it is not decreasing like some transitory inflation contribution. This non-food, non-energy purple one is transitory. It is passing easily, but the services is not. It is stubborn, and it is around still 5%. And now we are in the side of the Eurozone economic monitor. Please look at the chart first of all. It is again showing the Bloomberg financial condition bar, consumer confidence, services, the business expectation, manufacturing purchasing manager index, manufacturing PMI, and the unemployment, meaning how the employment market is following the current condition in the Eurozone economies. First of all, we should understand that there is a Bloomberg Financial Condition Index showing us there is lower recession risk because we are still in the green side. But if we focus on consumer confidence and manufacturing, meaning that production of the economies or consumption side, there is a huge recession risk in the Eurozone economy. The problem is coming from this side. United States is a financial market economy, but the Eurozone is a production economy. All Europe land equipped with the factories and production centers. And because there is a contraction in the demand with the decrease in the inflation, and because of the conflict in the Ukraine and Russia on their eastern border, all manufacturing orders from the rest of the world decreasing. And the ambiguity in the inflation and order expectation for the next couple of years, decreasing the manufacturing PMI for the rest of the Eurozone economies as well. And unemployment market is really good still, because we suppose that if there is recession in the economy, unemployment will be really high, and there will be some signal from the employment market for the recession as well. But unemployment market saying that there is no risk as like expected in the Eurozone economies, there is no risk of the recession. But as I say, the manufacturing and consumer confidence giving some alert for the Eurozone economies about the recession risk for the next couple of years. And now, please take a look at the Eurozone headline inflation breakdown. We are in January here, 21, just after 1 year in the COVID-19 crisis, and we are here. Please look at the highest contribution, energy, as you see. Energy giving the highest contribution for the European Union inflation contribution. Why? Because they are importing all the energy product from the Russian and Ukraine border. But then, when there is conflict and some sanction on the Russian Federation, there is a huge pressure on the energy prices for the Eurozone economies. But now, energy pressure is minus. There is no energy inflation in the Eurozone economy. Also, the contribution of the core goods, please look at this green one, it is decreasing. But what is the biggest one? Biggest one, again, core services, the light blue. What I state here, blue one, restaurant, hotel, transport, these are the services sector. Again, this light blue for the services products, putting highest pressure on the Eurozone inflation contribution. And the last one, food, alcohol, and tobacco. Normally, as you see here, food has the smallest contribution in the United States. But in the Eurozone economy, the food, alcohol, and tobacco still put a higher contribution for the Eurozone inflation indexes. So if we ask to each other, what is the problem in the Eurozone economies in their inflation contribution? It is coming from the food, services, and today as you see, core goods, services, and the food and tobacco, alcohol side. And please look at the percentage of year-over-year change. Eurozone headline core inflation. This is the percentage change, and this is the date for the axis. And as you see here, normally the inflation target is 2%. Please look at this one. This is the European Central Bank inflation target. And the core inflation, as you see, the black one, the headline is purple one. Headline sometimes above the inflation target, but the core, the black one, is always less than the inflation target. But after the COVID-19 crisis, both headline and core inflation has a huge pickup in the Eurozone economies. Today, after the shock effect of the COVID-19 crisis passed through from the economies, then inflation coming to the inflation target. It is converging, but still, as you see, headline inflation almost nearby the inflation target, but the services core inflation is not. Core inflation still above the inflation expectation and inflation target for the Eurozone economies. And now, the European Central Bank monetary policy. This is the expectation. This gray bar still showing the recession period in the Eurozone economies. And after the COVID-19 crisis, a huge increase in the interest rate. It is around 4%. Then gradually, as the inflation goes down, ECB cut the interest rate, but still the economy is expecting that after the 2025, when the inflation reached to the target of the ECB, the interest rate will still be above the 2%. It will decrease below the 2% at the end of the 2025, but after that, it will be again above the 2%. This is the ECB central bank policy rate expectation. And there is the government bond spreads over Germany. What is this showing? This right-hand side slide. The Germany is a benchmark for the Eurozone economies. And if your 10-year treasury yield spread higher than, let's say, 5 basis points, 2 basis points, then the Germany, like here, or like here, this is an indicator of the risk in the market. If Italy, Spain, and France 10-year treasury yield converge to the Germany, there will be no risk in the market, in the financial market. But if the spread is widening, then we will expect some increase in the risk and decrease in the risk appetite for the financial market. And the last slide for the Eurozone economy for today, it is economic surprise and recovery of the fund. This is Citigroup Economic Surprise Index, and this is two economies, United States and Eurozone. As you see, economic indicator coming above the expectation. It is normally in the United States. And today, as you see, the economic shock, economic indicator surprise is always less than the expectation in the Eurozone economy. And this is the European Union Recovery Fund grants. This is showing please look at this one, actual forecast disbursement, and then the initial plan. And as you see, the initial plan disbursement gradually decreasing here, less than 20 billion euro.